Hey everybody, back with another dividend analysis, and today we're going to be taking a look at Genuine Parts Company, or GPC. Wanted to take a look at GPC because, as we'll see later, they have been raising their dividend for a particularly long period of time, so I thought a big dividend appreciation stock would be something interesting to look at, since a lot of the ones we've had in the recent past have been things with dividend cuts or haven't been raising as much. So without further ado, let's get into it. As always, we'll start with the current yield sitting at just under 2.5%. Not too bad there, not too great, but it is doing about twice what you'd be getting from the S&P 500, so twice the wide market. But again, 2.5% really on the lower end of what you would consider a dividend stock, but not terrible. Looking at those dividend increases, we can see currently we're getting about 81.5 cents per share, whereas about 8 years ago we were getting just under 54 cents a share. As I said earlier, this company has been growing their dividend for a very long time. They are a dividend aristocrat. They are a dividend king, as they have raised their dividend each year for the past 65 years. So if you are a dividend appreciation investor, this is definitely something you want to, at the very least, look at. Over the last 12 months, they've paid out about $460 million in dividends. Let's see if they have been able to support it. First, looking at the cash flow, note that these are 2020 numbers because 2021 full year numbers are not in yet, so just keep that in mind. If you're looking at this, you want to look at those 2021 numbers when they come in. But we can see that over the past 5 years, the cash flow has been a little bit spotty, going down, then up, then down, then up. But it is a large uptrend over the last year, getting up to nearly $2 billion, doubling the highest in the previous 4 years. So definitely upward cash flow. We do want to see those 2021 numbers if those cash flow numbers have continued to elevate. Even if it isn't at this 1.8 number, if it was something like 1.5, even like 1.2, 1.3, we still have a good over the longer term increase in free cash flow. Looking at the ratio of free cash flow, extremely low here at just 25%, half of our ideal 50% ratio, so plenty of room left in the free cash flow to raise the dividend as they continuously do so. Things like that, no real danger of a cut unless this falls dramatically. Plenty of free cash flow to do other things with, so this is really good here, seeing this 25%. Even if they raised it by more than they have been over the previous few years, they'd still have plenty of room in free cash flow. Next, let's take a peek at the income. Going down to our income, we can see $163 million. As any of you who know anything about math, that's going to give us a negative ratio. I will note that though this really does seem to be an outlier, we can see here just almost 700 million, then we go to 600, back up to 8, back down to 650. This does seem like an outlier year, and I did look at the quarters for 2021 that are in. Almost every quarter is higher than this 163 million, so I would expect the income for 2021 to be higher than this, and very likely be higher than that 460. If we look at the other years, we can see it probably averages out to about between 60 and 70% of their income being used to pay that dividend. So while not ideal, it is definitely in the acceptable range, something they're able to afford. Again, seems like an outlier year, but you do want to see those 2021 numbers when they come out in full. So what does GPC do? As their name suggests, they create parts. That is mostly auto and industrial parts, so things that are used in cars, things that are used in industrial machinery, stuff like that. So it's very much a company that they will always be in demand as long as they're able to provide those parts. Some things you want to look at if you're looking at this company is that it will be tied to commodity prices, because the parts they produce are made out of things like steel, other commodities, things of that nature. So you want to check if there are big movements in those prices. For example, if steel became very expensive, they might have to spend more in order to make parts, whereas if something became cheaper, they'd be able to spend less. That might increase income, stuff like that. So you do want to kind of look at those commodity prices. It's really not a day-to-day thing, but if there's a huge drop or a huge spike in a commodity that they use to create parts, that might affect the share price negatively, positively, in a big way. So we come to the big question: should you be looking at this? Is this something you might think about investing in? From an appreciation standpoint, this is one of the gold standard companies. It is a dividend king with 65 years of dividend increases. As we can see here, they aren't huge increases by any means, 2 to 3 cents, but over 20 to 30 years, that's going to give you an amazing yield on cost. If you get in at, say, with the current price $135, in 20 years, if with inflation and GDP growth that price is doubled or tripled, suddenly your yield on cost is something like 7-8%, even though the actual yield at that time is only 2, 3, 4%. So keep that in mind. If you're an appreciation investor, this is definitely something you want to at least take a peek at. From the yield side, there's really not a ton here, sitting at just 2.5%. But again, this is one of those companies. It's a large blue chip company. It's not going to go out of business overnight. It's going to have to be something crazy, like mismanagement, something going wrong, something very wrong for this company to, splat or something like that. So it could be something like a stabilizing force in a portfolio that has a lot higher yields, a way to diversify into something, something that makes industrial parts. You're looking for a company that's involved in the industry sector, the industrial sector. This might be something for you. But yeah, definitely something to look at from the dividend appreciation side, and definitely something that's had success in the past, as we can see with those dividends increasing every year for 65 years. As always, thank you for watching, and I will see you next time.